hundreds of dollars, thousands of dollars, sometimes even tens of thousands of dollars. There is a part of crypto most people completely miss. Projects often reward early users by giving them their token when it drops. It's real, it's happened for years, and in today's video, I'm going to show you how it works and how you can participate. And the craziest part, people have no idea that it's happening. In 2024 alone, over $19 billion were dropped into crypto users' wallets. These weren't VCs, these weren't hedge funds, these weren't insiders. Normal people who simply used apps and protocols early before tokens launched. One project in particular, Hyperliquid, dropped $1.6 billion to early users. Many of those people did very, very well. Those who held, even better. Today, I'm going to break open the entire playbook. By the end of this video, you'll understand what an airdrop is, why they happen, why they're the best asymmetric bet in all of crypto, why the reward is unlike anything else that exists in finance, and most importantly, how you can start farming them safely. So whether you've got a little bit of money or a lot of money or no money at all, we will show you how to get started. Let's start from scratch. If you've never heard of an airdrop in terms of crypto, an airdrop in short is pretty much a reward someone gets for being early to a project, particularly before a token is launched. A cryptocurrency project will distribute tokens for early users. And yes, you wake up in the morning, you check your wallet, and sitting there are rewards. Lots of rewards, often very valuable. This is money you didn't buy. This is money you didn't trade for. This is money that was given to you, not for free, not as charity, but because you added value very early on to a particular project. I know this sounds too good to be true, but there's real logic behind it. And once you understand the logic, you'll feel a lot more comfortable putting your time and effort into this. Because projects aren't just throwing tokens at random people. There's a method to the madness. And once you understand that, you'll know how to maximize your input to get the biggest returns possible. This is half science and it's half art. Blend the two and you'll be capitalizing on airdrop opportunities better than 99.9% of the population. So simply put, these projects are rewarding people before the hype cycle, before the token catches on, before the masses enter. Let me give you an analogy. It's 2012. You open up the App Store and you see something called Uber, free taxi rides. Okay, what is this? You download the app, you check it out, and it basically tells you like, hey, we've got this crazy new product that will let you go and call a taxi directly to your door. And you can pay for everything through your iPhone. No worries, no strings attached. So you download the app, you take a few rides, you tell a few friends about it. You maybe put a post on social media and give it some attention. And heck, a couple of years later, Uber goes public and the team reach out to you and say, you know what? Thank you very much for being part of the Uber community that early. You were early. You believed in us. You gave us value you could never understand. So in return, here's $10,000 worth of stock. That is essentially what an airdrop is, except it doesn't come around once in a blue moon like a Silicon Valley unicorn. It happens all the time. I'm not talking yearly, I'm not talking quarterly. I'm talking every single month, time and time again, and there's a method to the process. And the amounts aren't small. There's a lot of money on the table. For example, if you partook in the Uniswap airdrop back in 2020, all it took was for you to make one transaction and you would have earned over 400 Uni tokens. This turned into $1,600. And heck, if you held over time, that would have passed $12,000 at its peak. Then in 2021, we saw DYDX. If you played around with the DYDX protocol and you traded at least $1,000 worth of volume, you would have earned $35,000. And heck, in 2023 alone, the Arbitrum airdrop, over $2 billion, distributed to users who interacted with the ecosystem early. And it only took a couple of minutes. You need to understand that these are not isolated events. These are not irregular. These are the norm and they happen all the time. This is not the lottery. So you're not going into this trying to get an airdrop every now and again. If you dedicate time and effort and a bit of capital to airdrop farming, you can set yourself for a genuine second income stream, something that has the potential to change your life. I always say there are two sectors in crypto that have exponential upside. Both come with huge risk also. These are meme coins and airdrops. Not for the 200x, but because you're literally turning borderline $0 into thousands. In the grand scheme of things, that leaves meme coins in the dust, doesn't it? The question right now isn't whether we're going to get some other big airdrops in 2026. It's how big and when is it going to strike. So why do projects do this? Naturally, this sounds too good to be true, and I get it. But when we take a look at why projects do this, you'll get a much better understanding about how this is not charity, this is a two-way thing. So yes, why would a project do this voluntarily? Why would they give away millions, and in some case billions of dollars, just for you playing around with their products early? What's in it for them? That's actually a very important question, because once you understand the mechanism, you'll know how to maximize your returns. It's actually one of the coolest things within crypto, and it's baked into the very DNA of crypto itself. There are four main reasons projects do this, and we're going to go through them one by one. And it will change the way you think about the space. Number one is decentralization. When crypto started, that's what it was all about. And over time, unfortunately, because of investment, because of expansion, because of investors and VCs, a lot of that was lost. And most crypto projects became very, very centralized. And it took away what made crypto special in the first place. Decentralization is what most crypto projects need if they want to succeed. You can't have a centralized token. If the founding team is holding most of these tokens, they're not worth investing in. That's a huge problem for the companies from a regulatory perspective, but also as investors. We can't risk putting our capital into a project where the team is holding 50% of the supply, that do unlocks every couple of months. Why would we ever hold? Every time an unlock happens, naturally, the price is going to tank. So it makes no sense. Centralization defeats the purpose of crypto. So step one is becoming decentralized. And by doing an airdrop and giving away tokens to early adopters, you're basically automating that decentralization process. So that's advantage number one, and primary reason why these protocols do airdrops. They go out, they airdrop millions, if not tens of millions of dollars of tokens, and heck, now you've got a decentralized project from the very beginning. You don't have to worry about dodgy tokenomics, and you don't have to worry about a bad reputation, because everyone can look around and say, this is fair, we're confident, it's a more resilient token, the token economy is healthier. That's not just nice to have, that's a necessity. Number two is user acquisition. Think about airdrops as a type of affiliate program. You know, if you're a company and you want to go out there and get users, you give them an offer they can't refuse in hopes that they go out and they market for you. That takes you to the loyalty stage of the sales funnel. When you go out and become an advocate, that exponentially increases your lifetime value to your customer. Google, Uber, Meta, all of these companies do the same thing. They spend billions of advertising dollars trying to grow their projects. Crypto is doing this in the same way. That's why they do airdrops. By going out and dropping tokens into your wallet, you immediately become an advocate of the project. You are now invested. You have a vested interest in the project's success. And by doing that, they're able to build a loyal user base and bring in users without spending tens of millions of dollars on traditional advertising methods. And it's just far greater too, because all of these people are psychologically invested in the success of the project. So it's a phenomenal marketing tactic, getting the tokens out there, acquiring more users, pushing them through to the ultimate stage of the sales funnel. Being an advocate, it really becomes a no-brainer. If you are going to put the same capital into the markets for advertising, why not give it to your loyal holder base who are likely to continue holding and have more passion for the project than a random Meta or Google ad? Within this, the cost structure is also very efficient because most startups don't have tens of millions of dollars to run ads, but they can always give the forward promise almost a type of IOU for people to go out and do the marketing. It's like someone comes to you as a traditional business and it's like, hey, I will run your advertisements. In return, when the money comes in, I'll take a cut. And if the money doesn't come in, I'll leave it. It becomes a no-brainer for the project and for the advertiser. Number 3, and this is a very important one, it's liquidity. In short, when a project launches a token, there needs to be a market for it. If there are no buyers and there are no sellers, there's no interest and the project immediately dies. People often think, I want everyone to buy my token, I don't want anyone to sell it. But that doesn't work, because if no one is selling, people cannot buy. If you don't want the project to die, it needs trading volume. It needs an active market, because if you launch and no one's holding it, nobody's trading it, and you are dead on arrival. By distributing tokens to thousands, if not tens of thousands of people, immediately you have people at your store. It's like going to a traditional market. You want people there. That's what creates a network effect. You need people partaking if you want activity and growth. A lot of traders will completely ignore cool protocols if they don't see trading volume, because you need volume for volatility and you need volatility for opportunity. Number 4 is community alignment. No one is going to support a project better than its early adopters. The best crypto projects aren't just products. They're a team, they're a community, they're a family, they're movements. We've seen this with the rise of meme coins. We've seen the passion people can have for a project that has nothing to bring to the table outside of a JPEG. So hey, you find a cool product and you build it, you manage to pull in a fan base, heck, even if your project is rough around the edges, these loyal users will be there to support you and they'll promote you. They'll be advocates of you. You're basically creating a tribe of very loyal people early on. If everything was to crash and go to shit, we'd have a couple of thousand people who never go anywhere, and they are the foundation of your business. So by tapping into community, by giving away these tokens as a true reward, not as charity, you are building up a tribe. These people don't just hold and buy your token. They defend it, they market it, they bring other people in, they enable its growth, and that alignment between team and community, that's worth more than any marketing budget could ever buy. Those are the 4 primary reasons projects do airdrops: decentralization, user acquisition, liquidity, and community alignment. When you receive an airdrop, you're not getting charity, you're being compensated for providing value for the project. And now that you understand that, you can start to see how there's a method to it. The more value you can give to an early stage project, the more return you're going to get later on for your participation. This is simple economics, and it's a great business model. It's a great channel for growth. Therefore, it's not going anywhere. It's not some BS Ponzi scheme that sounds too good to be true, is it? Now you see your value. Now let's talk about you, the farmer. I've said this at the start, airdrops can change your life. And when I'm saying that, that is not hyperbole. Truly, airdrops provide the biggest asymmetric risk reward in all of crypto. You are sometimes putting in $0, almost zero risk, and you have the potential to earn thousands, tens of thousands, if not hundreds of thousands of dollars if you play the game right. You can't put a multiplier on this. People say that in traditional finance you talk in percentages, and in crypto you talk in X's. Well, in airdrops you can't even talk in X's, because how can you put a multiplier on $0 to $1,000? You can't. And if there's one thing I want you to take away from this video, it's understanding that equation, that relationship between risk and reward, which makes airdrops a non-negotiable when you're building your crypto portfolio. Look, you can buy Bitcoin, you can buy stocks, and it may go up, it may go down. Let's say it goes well and you make money. Fantastic. But there is still significant downside risk. Let me ask you, what is the big downside of an airdrop? Of course there are issues. You are putting your capital at risk because, hey, there's an opportunity cost. If you're spending $5,000 to put into a protocol to lock in to, let's say, a lending market to earn a future airdrop, maybe that money could be put into the market and it might double in the meantime. That's the opportunity cost of that. And that's the impermanent loss. At the same time, yes, you use protocols to play around and bridge funds. And what if there's a bug or an exploit in the smart contract? You could lose your funds. So there are risks, but fundamentally, what's the downside? you're putting in borderline zero. You may be paying for a few fees, and your rewards are exponential. You can't put a cap on what this means for you. I've never seen a vehicle in crypto bring larger upside for some minimal effort and time and energy sink. It just makes sense. If it makes sense, it makes sense. Okay, so now I want to talk a little bit about the actual downsides, because the risk-reward relationship is insane from the capital you put in versus a return, but these are not completely risk-free. There are other intangibles that you have to factor in. For example, you are playing around with protocols that are very early. It can be a bit of the Wild West, and when you're doing this, that can be quite dangerous. If you are not safe and careful, you may play around with a protocol that has a bug. If your operating security is not dialed in, what if you click the wrong link? What if you do the wrong thing? Your money can get drained, right? That's a problem. And heck, look, if you're doing activity in DeFi, sometimes these fees can add up. We've all done it. We send a transaction on Ethereum for $100 and you're paying $2. And if you don't pay attention to it and you do it at the wrong time, maybe you're paying $4. And so when you're going around playing and experimenting in this DeFi space, you are going to rack up fees. And if you're not mindful of those, it's unlikely, but the fees may stack up to the extent to the airdrop being unprofitable over time. So you do have those risks when it comes to farming airdrops. We will discuss security later on in the video to make sure this does not happen, but I'd be lying to you if I said at this stage you didn't need to think about these things. So be careful, stay safe, be mindful of potential fees and potential exploits. Set up some best practices to make sure that doesn't happen. We're going to talk about that later, and it becomes a no-brainer. That's just the reality of DeFi. There will always be security issues. However, the biggest cost when looking at an airdrop is actually the time you're putting into it. You're not looking at price, like the money in versus money out, because there's simply nothing else like that out there. But you need to look at the time you put in versus the time out. If you spend 10 hours working on a project and you get $400 in return, was your time worth $40 an hour? You might be able to get that elsewhere. Or maybe that's great for you. Whereas you put 10 hours in, you get $40,000. Hey, very few opportunities in the world will get you those type of returns. So you must keep an eye on how much time you're putting into these things. And that's what we're going to go on to next. The core of this video is figuring out a strategy for us. And it all works on a matrix. How much time do you have and how much money you have? So you need to ask yourself those questions and see where you fall on what we're going to call the airdrop matrix to see what strategies you can deploy to win in airdrop farming. Before we get started on the airdrop matrix, there are two things you have to consider before setting up your strategy, and they set the foundation for everything. You control two things. You have technique and you have commitment. Technique is all about knowing what to farm and how best to farm it to get the biggest return possible. And commitment is how much effort and how much of a willingness there is to play around with these protocols to get a return. And if you correctly marry this relationship between technique and commitment, that's how you create a strategy that works best for you. So learn to farm airdrops. Learn to ask yourself the key questions. What matters to this protocol? When we look back at our Uber analogy, sure, they'd be happy if you kept retweeting them on Twitter. But do you think that mattered more than going in there and actually taking rides? Of course not. And for a lot of these protocols, you can go and engage in their Discord community, but it probably means more to them if you go and play around with the project itself. If they're an exchange, they value swaps. If they're a staking protocol, they value staking. If they're a lending market, they probably need you to give capital to lock into a vault. There's no point going to a project like Aave and retweeting their posts. They don't need that. They don't need social engagement. They need capital deployment. If you don't have $10,000, then maybe that's not the one to farm for you. I'm just giving a hypothetical example. People often make the mistake of asking myself for a simple strategy, how to get started and how to win, but it really is a case-by-case situation for you figuring out who are you, what is your profile, what level of technique are you looking to develop, and how committed to this journey are you. At the start of 2026, we launched an initiative, Road to 100K. It's a relatively generic target, but I wanted to tap into the most common user I see. These are people with low 5 to 6 figures. If you're a 5-figure guy, could we spend the next 12 months to take you to 6 figures? My answer is yes, and that's how we're going to do this. That's what we're going to go over, but it comes down to developing technique and being committed. So we're at the stage in the video where we're about to get practical. I'm going to define the airdrop matrix. I'm going to give you the 4 different types of people I think you need to categorize yourself as if you're going to start farming airdrops. And then we're going to look at the best tips, tricks, and techniques for each of these types of people. Let's see where you sit, and then you can get a better idea of how to get started. This is the practical. This is what you're here for. So pay close attention. Grab a notebook, open up a Google Doc, take notes. Understand yourself, and that's how you'll win in the airdrop space. Because opportunity is abundant, but it comes down to how you execute. Okay, so let's get stuck in. 2 variables to keep in mind is how much capital you have on hand and how much time you can commit. And that puts you into one of 4 categories based on that. So what profiles do we have? We have 4. The first one I want to go over is the grinder. And now I don't relate to this guy right now. I'm in a different part of my journey, but I was there once upon a time, and I work with a lot of people who are in this position. This is a guy with little capital, maybe 0, maybe a little bit. Now, this guy doesn't have much capital. Maybe he's between jobs, maybe he's a student, maybe he, is working part-time, but he's not getting the return he wants. This guy doesn't have capital. What he does have is hunger, and he's willing to commit. He has time. For this guy, he hasn't built his portfolio yet. Maybe he has nothing called 4 figures, but his goal with airdrops is to get stuck in and do as much as possible. It really is a matter of how much time can he sink into this and how much of a return can he get. I would recommend this for a lot of people. If you got $1,000 in crypto, people might say, what should I do? Should I buy Bitcoin? Should I go and put $100 into 10 different meme coins? And hey, both will probably get you an upside, to be honest with you. But if I was to do one of those things with $1,000, it would be airdrop farming. So what is the game plan of the grinder? The game plan is volume and breadth. You want to interact with as many protocols as possible, because you can go and get one big farm from one place, but there's still a risk that they don't do a lucrative airdrop. But if you play around with as many as possible, you become eligible for as many airdrops as possible. You're casting a wide net. This works because oftentimes companies reward you for activity. The more you do for them, the more they give you. However, if you can't do much for them, they still want to reward you for doing a little bit. So instead of doing tons and tons and tons for one particular project, do a little bit for many different people. If I was to give you an analogy of making money, you see a lot of people online now on Instagram, on TikTok, on YouTube Shorts, and what they're doing, they're going around a neighborhood and they're offering to clean windows for 50 different houses. And they're launching a side hustle on eBay where they're selling, bicycles. They're doing so many small little things, and they're grafting, they're grinding, they're embracing the grind, and that's why they make money. And that's what you're doing here. This does not require money. This requires time. And here are the few things you need to look at and the little tips and tricks I have for you to maximize your returns. First off, look into testnets. Testnets are your biggest weapon. In short, what makes these special is they're basically offline projects. So these give you the advantage where you can interact with protocols with 0 fees. So even though fees are often very cheap on chains like Solana, we're talking less than $1 for 10, 20 transactions, that can still add up. Whereas on the testnet, there's 0 cost. There's 0 risk also because you're not online, you're not interacting with crazy number of protocols. The cash cost could be tiny. Your main investment is the time you're putting in. And look, you may receive a token for testing a blockchain early, but there are always risks and they don't always pay off. When the real project launches and the real token launches, these people often get rewarded the most because you're talking super early and literally no fees. Next tip is look into bridging. Bridging is when you move funds from one chain to another. Oftentimes when it comes to bridging, you're moving funds across very cheap, affordable blockchains. And when you're moving across these blockchains, you're often likely to get good returns. By doing this, you are significantly improving the odds of an airdrop. If you go and you are moving funds around the Ethereum ecosystem, you get rewarded from Ethereum. But if you're moving funds from Ethereum to Arbitrum to Optimism and beyond, now you're playing around with many more protocols. You're essentially increasing your on-chain footprint. And the more thorough your on-chain footprint, the more eligible you are naturally becoming over time. Next up, look into these concepts called faucets. So many testnets have faucets. Faucets give you free test tokens. Use them. Interact with every single feature of a protocol. Swap, provide liquidity, mint. Whatever actions are available to you, use them. And in return, these free tokens are often compounded. Fourth, community engagement. This is one that most people sleep on because they can't imagine the value. Because unless you run your own business, or something to the effect of that, you can't appreciate social engagement. One of the most valuable things you can do for me is dropping a comment below and liking this post, or going and sharing it on Twitter. It helps me more than you can imagine, and please do so. But that's what these protocols want you to do too. So it might seem like a small thing, but by engaging with the community, you're helping out a lot. Look, if you go into the comment section now and you ask a question and someone else comes along and answers your question, then you ask another question and someone else comes and answers, immediately you're going to start seeing the value of being a subscriber. So of course I'd be appreciative of people who are going in and engaging. And that's essentially what you're doing when you get stuck in and engage with the community. Number 5, this is focusing on protocols that do not yet have a token. Airdrops don't always happen in one stage. Oftentimes airdrops are staggered. They do early airdrops before tokens launch, and then intermittently every couple of months to improve decentralization, to get more users on board, to increase liquidity and so on. But you're likely to get the biggest bang for your buck by partaking in airdrops that are at stage 1. I definitely encourage you guys to partake in an airdrop that doesn't have a token yet. Whereas, hey, when you've got more capital, then perhaps farm an airdrop that already shows an upside in resilience. If I go now and I farm an airdrop for an unknown token, I'm going to get more tokens, but they may have 0 value on launch. Whereas if I go and farm a potential hyperliquid stage 3 or 4 airdrop, I already know the value of hyperliquid. So the odds are a lot better there. If I were you, I would focus on those that don't have a token yet. Okay, on to profile 2, and I would say most people watching this video fall into this category. You've got a little bit of capital and you've got a little bit of time. You have other commitments, right? You maybe have $10,000 and you maybe have a full-time job, but we work 8 to 9 hours a day. You know, there's 24 hours in a day. If you're not sleeping, you're not working, what are you doing? So that's who this guy is for. A few $1,000s, maybe 10,000, 20, 30, and a job. So he's got mixed commitments. The approach that you have to take is completely different to the grinder. You have to be more selective with what you're doing. You don't have all the time in the world, but you can't afford to play around with everything. You need more certainty, but you still need to cast a wide enough net where you're not leaving obvious opportunities on the table. The strategy here in a single sentence is targeted farming. This is where you are focusing on quality over quantity. The playbook is simple. Step 1, identify 5 to 10 high conviction airdrops. These are airdrops with very strong odds. Perhaps the team have confirmed it, there may be leaderboards, and everything is already public. So it's pretty much a lock. You're committing your time to an airdrop that's been publicly confirmed. And you can be confident that, okay, I'm not wasting time just pressing buttons. It's important for you to research these projects. Look at the funding, look at the team. Have they been docked? Have they launched tokens before? How did they perform? Maybe they've already done an initial airdrop and this is their second airdrop. We recommend this for a lot of people. Tip number 2 is deploy capital into these protocols. Make swaps, provide liquidity, stake, use their lending features. If you didn't have any money, I wouldn't recommend this because you're not going to be providing that much value. But if you have capital, put it to use. If a company out there is valuing trading value and you only have $100, you would have to transact 10 times back and forth and $1,000 worth of volume. Whereas if you have $1,000 of volume, one transaction does it. And that's something that continues to scale as we look at some of these tips, but I would definitely recommend you go out and use this capital as it doesn't take long to stack up. Number 3, and most people at your stage get this wrong, is stay consistent. Don't delude yourself. You still have to put time in if you want a big return. You know, putting capital to use is great, but it's not like you're sitting on $100,000 or $500,000. You have time put into this, right? You still have enough capital to catch up to those people with big capital, but only if you put the time in. You can't do a couple of transactions and leave for a month and come back. Step 4 is staking wherever you can. Staking is powerful. And yes, combination now of time and capital, but it's not time as in how much time can you commit, it's How early do you get in and do staking? Staking shows a protocol, you believe in them, you have confidence in them, you're here for the long run, and it gives you confidence. There's projects out there that if you stake, a little bit of capital for a long enough time, the rewards will be so much greater than someone who stakes a lot of capital for a short amount of time. So there are many opportunities out there. Step 5, the point systems. I mentioned earlier on, leaderboards. Well, a lot of these things are public. You know what actions protocols want you to take and lean into it. You don't have to be a wizard to do that. Go look at their websites and see what they want you to do and stay targeted. Don't spend time doing 50 different things on a single website. If they've come to you and said, look, we don't care about social engagement. We want you to focus on transaction volume. So put your time into the things stated they would reward loyal users early. Now, not all protocols are public with this information because they want a wide variety of feedback. It all comes down to feedback loops if you're one of these projects, but we absolutely go out and we shortlist what we believe is the most valuable thing for you to do. And a lot of it is common sense, right? What do you think mattered more to Uber early on? You taking a ride or you applying for a license to be a driver? So much more to be a driver, right? Because there were fewer people willing to do that. So think of it like that. I would say check the leaderboard very, very often and keep an eye on where you rank. If you're in the top 10, you will get a ridiculous outsized reward than being in the bottom 50%. And oftentimes, you're a single action away from jumping up hundreds, if not thousands of spots. Next tip is track everything. You can use platforms like DBank, Jupiter Portfolio, Rabby Wallet to monitor your on-chain activity to see how your points are stacking up. DBank is incredible for the EVM chains. Jupiter is one of the best portfolio things you can use on Solana. DBank basically has no Solana coverage, so that's where you need Jupiter Portfolio. You know where you're active, you can see your digital footprint that we've been talking about. And maybe there's one particular area that you just haven't explored, and it's very easy to acknowledge that when it's right there in front of you. So it gives you a snapshot. You are a sniper here. You're not running around with an AK-47, you're a sniper. And snipers need to see the big picture. One of the coolest examples I can give you is a true story. We presented a GTO strategy where we told people to stake 1 Solana for 2 months. You know how much money these people earned on average? $10,000. Whereas people who staked 10 plus Solana for the week before the airdrop, they got a few $100s. So it just goes to show that you need to keep an eye on what the project is looking for and put in a very clear strategy for what they value. GTO in this case needed time. Next up is profile 3. This is the deployer. And to be honest with you, this is me. Who is this person? We have good capital, but we don't have much time. Maybe you're running a company, maybe you're running a full-time job and you're a student. Maybe you made huge capital in crypto, but crypto isn't your life and you can't commit that much time. Well, there's great news here. You can win with airdrop farming if you have big capital with only an hour or 2 a week. That sounds crazy, but you're actually very well suited for airdrops because many projects need capital. They're almost like early stage startups who value investing from big VCs over crowdfunding. And you are that big VC in that regard. For example, if you go in and you need to produce trading volume, it may take a guy doing 50 transactions of $1,000 to get 50K volume, whereas you do one transaction of 50K and you've ticked it all off. Now, you don't want to be overly spread on this. You don't want to be in too many protocols at once because you've got more capital, you're at more risk when it comes to potential breaches in security or protocol issues or smart contracts risks. But you can still get stuck in and maybe play around with the ones that are a bit more certain. The strategy is called capital weighted farming. Don't play around with 100 protocols that are doing tiny transactions. Fewer, bigger transactions. That's what you need here. Tip number 1 is focus on protocols that are valuing total value locked more. Maybe it's a lending protocol and they're telling you, if you want to rank up the leaderboard, put in a lot of capital. That's what we value. There's a lot of these protocols out there, typically lending market, staking market, that's what you do. It's very unlikely you're going to come in and benefit from bridging a lot of capital back and forth, but putting your capital up and leaving it there for a couple of months in a vault, that makes sense. The con here, once again, is you're not putting this capital to the market, but in a risk-off environment, it makes a lot of sense. Step number 2, which is almost an expansion of that, is supply the liquidity on layer 2s and DeFi platforms. Because in comparison to some of these bigger projects, they don't have as much capital. If you go to Aave, for example, they might have $5 billion locked, whereas Camino has $500 million locked. So if you put the same 50,000 in each one, obviously the smaller project, Camino in this sense, is going to value your $50,000 so much more. Another tip, and I feel like for this one, we're compounding for the deployer, is use lending protocols to put your capital up and deposit them and take a loan against those assets and redeploy. You're almost creating a chain of deployment by leveraging the borrowing and the lending side of things. And oftentimes, these protocols are the ones allowing for it. And on many occasions, you can get delta neutral plays. When you're borrowing your assets to some of these vaults, you may be able to find opportunities where there's an arbitrage there, where you are getting more money for lending than you're spending on borrowing. So if your supply APY is so much greater than your lending APY, you can figure out a cool kind of opportunity where you're getting even more bang for your buck. Just be aware that you have to look at these relationships. If you're putting in capital and earning 2-3%, whereas if you're borrowing capital and you have to pay 10-15%, it's probably not worth it. But that's something we also do. We look around and we find these arbitrage opportunities, and they're very lucrative. I'm in a couple of positions right now that I'm actively talking about with the community. Tip number 4, and this is a privilege you have that no one else does, is you can pretty much take a set and forget mindset. It's not about activity. Come in, put in your capital, have a strategy running. Unless something alarming comes up, in which case you probably see it trending on X, just leave your capital to work. Come in once a week, maybe even a couple of times a month, and reposition. But you've got a very hands-off approach. If the first two, the grinder and the strategist, are traders, you are more of an investor. The ultimate mindset here is simple: position and leave, right? Adjust periodically at the most. Collect when the airdrop hits, but don't do much in the meantime. Perfect example in this case was Hyperliquid. They were awarded for the total transaction volume, but it came down to doing a couple of big transactions over many. Whereas maybe for a grinder, you want a protocol that's going to reward you off number of transactions, not volume. People earned 100,000 plus on Hyperliquid on day one because they were deploying, $15, $20 million. And that might sound crazy, but if you have $100,000, it only takes 10 transactions to get $1 million, right? So keep that in mind. And the fees are basically zero on Hyperliquid. One airdrop, one day, and that's what weighted farming is. And finally, the profile all of us want to work towards is the maximizer. You have time and you have money. You can do everything possible. You are basically an amalgamation of all the other techniques. You're the dream. And you're what all airdrop farmers are looking to work towards. And you just have to capitalize on the full spectrum. I would say the only thing you really have to look at that's different to the others is even more attention to your security. Because now, if you're using big capital across so many different projects, you have to keep an eye on hey, I really cannot afford a security risk. A $5 transaction on a new L2 is very different to $5,000 on a single transaction on a new L2. So you're basically combining all the different profiles together, but because you're putting so much time and capital in, just pay even more attention to the best practices we're going to talk about after this section. A couple of quick tricks is delta neutral perpetual farming. This is one of the most powerful strategies right now that people are using. It's how serious farmers are generating crazy volume. You're basically creating delta neutral plays where your directional market risk doesn't matter. Think about things like a basis trade. You put in a short and a long and you're collecting fees while your position remains neutral. Pretty decent when markets are doing well too. Then of course, lending markets use two different protocols, borrow, lend, and you can be farming two protocols at once. And because you've got big capital in, your returns are a lot higher. Once again, no directional risk. I would say that's a common thing that's going to come up with you. You've got big money, don't risk it, right? Just put the capital into things that you don't care if they go up or down. They're going to stay stationary. And heck, if it is some of these lending markets or the staking markets, you can earn a pretty sizable yield. If you're able to get 15-20% APY and you can put in $500,000, $50,000 to $100,000 sitting in a position is no joke. Never mind the airdrop reward that's going to come up later. Step 3, and this is not about the capital, this is about the time. You have the time. So like the grinder, you need to be at the forefront. Be early. No one is rewarded more than those who are early with a lot of capital. As we said, there are more risks that come with this, but you have the time, so there's no excuse. There are so many apps and tools out there for you to be alerted when an airdrop drops. The mindset for this profile is this is pretty much your primary job. It's not even a second job. Treat it like one. Look, you've got a lot of money, you're clearly good at something, or you wouldn't be in this position. You wouldn't be a maximizer. So now that you're here, commit to it. Make it a full-time job. Put in your 6-8 hours a day. And if you don't want to do that, we all have other things. You've earned your freedom, I'm sure. Still treat it like a full-time job. Be a professional. That's how you get the advantage you need. Those are all the profiles in our airdrop matrix. We have the grinder, low capital, high time. You're playing a numbers game. Test nets, bridging, community engagement, social contribution. You're casting a wide net. Your biggest skill is your time. Then you have the strategist, which is most of you. You have to have targeted farming approach. 5 to 10 protocols, be consistent, track your points, quality over quantity. Then the deployer, lots of money, not much time. Lending markets, staking markets. This is where you need to be putting your capital. It's all about weighted. You don't want to do too many things. Maybe instead of 5 to 10, you're doing 2 to 5. Limit the number of airdrops. Maybe go for airdrops that have already done airdrops that are around 1. And set and forget. Check it once a week. Lastly, maximizer. This is your full-time job. You're combining all of the others. Big capital, lots of engagement, and yeah, just get a combination of all of the above. Get everything running smoothly, and then perhaps look at how you can automate some of these processes. So my ultimate goal with this video and this section we've gone over is to show that airdrops are there for everyone. There's often misconceptions that airdrops should be for people who have no money or are broke. Everyone likes the idea of being rewarded for being early. Who wouldn't? Small anecdote, and we were running meta ads. One of the ads that did best was earn your first $20,000 with airdrops for free. And it makes sense. Where else in the world of finance can someone take a couple of $100s and turn it into thousands and tens of thousands of dollars just by basically playing a game? And throughout that process, you're actually learning and growing and getting better. And if there was one thing I would recommend to someone new who's getting into crypto, who wants to learn about crypto, not from a financial perspective solely, but someone who really wants to learn the ins and outs of crypto, DeFi, etc., I would say use airdrops. There's no better way to get familiar with these different ecosystems and get really sharp at what you're doing. There's nothing in traditional finance like this, no better education, and no better financial opportunity. Airdrops truly are the great equalizer. And the window is still wide open. We've said over time that these things will continue because they make economic sense. However, when they become mainstream, rewards will be spread more thin. You want to get in now because not that many people are aware. Go out, ask a family member, ask a friend, ask a colleague. Do you know what airdrop farming is? Come back to this video, drop a comment. I'm 99% sure the first person you ask won't know. You ask 10 people, maybe 2 or 3. You are early, my friends, and as we've said time and time again in this video, that's what matters most. Now, before we finish this video, we are going to go over security because none of this matters if you get hacked or scammed. Farming means you're interacting with protocols early. As we said, early equals Wild West. You do not want to get caught in a shootout. It's not worth it. You're connecting wallets to protocols you've never heard of. You're signing transactions automatically. You're not reading through the smart contract. You're putting heavy capital at danger very, very often. So security is essential, and we're going to quickly go over exactly what you need to do to take your operating security to that next level so you can go in and start farming airdrops confidently. So here are my security non-negotiables. Number 1 is use a dedicated set of wallets for airdrop farming. Never use your main wallets. Never use wallets with your spot positions. Look, no one wants to get hacked and no one wants to get scammed. But if it's gonna happen, you might as well do it with a couple of $1,000s that you're using for airdrops than your whole crypto portfolio. So absolutely always use farming wallets. And of course, move funds out of there when it's time, but never use your main wallets. That's an essential. You cannot do that. Create separate wallets, perhaps even on separate devices if you want to be really, really secure, but definitely do not use your main wallets. You can't afford for your spot positions to be compromised when you're playing around with new protocols. It's happened to me personally. I have been hacked and scammed. If it happens to me, it can happen to anyone. Never use your main wallet. Number 2, continuing with wallets, use a hardware wallet. Use something like a Ledger or a Trezor. These things are very inexpensive. You can get a Ledger for sub $100. And basically what it's doing, for those who aren't aware, is when you do a transaction, you have to manually sign it. You're pressing a physical button. So if in the back end, you've given your wallet out and someone tries to use it, well, they can't without pressing a physical button. And ultimately, if you're in control of that, your operating security is so much more thorough. You're hiding your private keys. Your money is way safer. This extra step can be the difference between making and breaking it. Ledgers and Trezors, they're very inexpensive, and they can be the difference between losing tens or hundreds of thousands of dollars or keeping tens or hundreds of thousands of dollars. Next up, and this is just a personal one, is use Rabby Wallet. Now, disclaimer, we are not partnered with Rabby and they're not a sponsor. We are completely independent, never spoken to anyone from the team, but we like their product. Rabby is probably the best wallet in my opinion for airdrop farming. I say that because it's genuinely better. It shows you exactly what a transaction is going to do before you sign it. It even allows you to do a simulation transaction where if there's a warning or a red flag that you need to see, it brings it to your attention. And this isn't some complex coded language that you're not going to understand. They extract the risk and give it to you in layman's terms. If you're using other wallets like a MetaMask, it doesn't do it. Even if they highlight a red flag, you oftentimes won't be able to understand because they're not explaining the issue with the transaction. Tip number 4, and we can move away from wallets now, is revoke unused token approvals. Every time you interact with a DeFi project, you're basically giving it permission to use your tokens and play around with your wallets. Well, you need to intermittently go in and revoke this access, because oftentimes, even way beyond and after you've done an airdrop, you haven't gone in. And if that protocol then has issues, people can basically get access to your wallet. Once you go in and you're farming dozens and dozens of protocols, even one misstep can catch you out. And it doesn't have to happen in real time. You might use a project a year ago, but if you haven't revoked access, it can come back to bite you. And as quantum computing increases and AI becomes more powerful, these risks will compound. I highly recommend you immediately go and revoke access to these things immediately. Even if you're not an airdrop farmer, we'll give you some tools later on. And if you're about to get started, I would look to do this once a week or once a month at the very least. It takes 5 minutes and it can save you thousands and thousands of dollars. The next one, and I'll keep this one short and sharp, is bookmark everything. There's been exploits where companies, scammers will go out and run Google ads on a particular protocol. So it appears number 1 in the search engine, and it's a mirror of an existing website. And you think you're interacting with the real thing, but you're interacting with a replica that has a bug on it. So the key would be to go to their official profiles, open the link up directly from maybe the Twitter bio, and bookmark it. So whenever you're coming back to that protocol, you're not risking getting caught offside by some search engine. You're using the official product. We mentioned earlier on when we spoke about Rabby, but you can simulate transactions before you actually do them without the risk. Now, Rabby does it automatically, but there are tools out there like Pocket Universe, Fire, that can overlay on top of your existing wallet like a MetaMask that does the simulation. So especially the first time you do a transaction on a protocol, always use one of these simulation techniques just for extra security. If anything looks off, these tools will catch it. Lastly, you will become eligible for a lot of airdrops, but do not rush to claim. I've seen it happen many times. People come to me and say, Adam, have you claimed X airdrop? I'm like, what do you mean? They haven't announced it yet. It's not there. They're like, what are you talking about? I got a message on my wallet and I can claim my tokens, or I saw this website and I've claimed. It's like, you can't claim something that hasn't happened. You can't do that. So make sure you aren't rushing to claim rewards. We all want that adrenaline spike. We want that dopamine hit, but don't go and claim anything until you can triple verify it on multiple sources. I'm talking official channels, I'm talking other farmers. And look, before we wrap up, disclaimer, all of these projects and companies I've mentioned throughout this video, no partnerships, no sponsors, we have no relationship with them. Ledger, Trezor, Rabbi, Pocket Universe, these are just products that we use internally that I wanted to share with you. I will include every link down in the description, and I'm sure you can go out and find an affiliate or a discount code for them. But just for me to you, I need to make clear, not sponsors, not partners. Okay, congratulations. You've made it this far. You've learned a lot. You know what an airdrop is. You know why companies do them. You know how you benefit. You know the best practices for security. You hopefully have a good idea of where you fit within the airdrop matrix. You understand the different strategies and techniques you can use depending on where you sit. And now the question is, what path do you take? What's your action from here? Are you going to go out and start farming? Have you been taking notes? Are you going to go watch this video back? For me, there are two clear paths from here for everyone looking to farm. Thank you so much for watching. I really appreciate it. Please drop any comments and feedback below, and we'll see you in the next one.